Hi, everyone, and welcome back to the Ask Avidian podcast. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. Let's get started.
Salesforce, Snowflake, a few other software names falling sharply to start the week again as AI disruption fears pummel the sector.
Iran's supreme leader, the Ayatollah Khamenei, is dead.
Iran's threat to set ships ablaze in one of the world's busiest trade routes is raising some concerns about the implications for the global economy.
All right. Questions?
Joining me today is Andrei Costas. Welcome back.
Thanks, Jake.
We don't always have the privilege of your company, but when we do, it's usually when there's something big to talk about. And
Right.
So today, when we outlined this podcast a couple weeks ago, it was exciting because we were going to share some things from our private client report, which is something we spend a lot of time working on, and we're always excited to get that out in front of our clients and, special friends and family and just connections, right? However, since that time, the world has changed a little bit. A couple things have been added to our list today that I think are going to be pretty exciting. We'll try to focus on the most relevant stuff, but we got to touch on some topics that are definitely moving markets. Over the past couple weeks, SaaS-pocalypse, which is a term that the media has given the disruption in public and private markets related to AI and SaaS companies. We also have a new conflict to discuss, the war in Iran, which at this point is 5 days old, but still having a major impact on public market volatility. We can see the impacts on commodities. We can see the impacts on trade, or at least the fear of what those impacts might look like over the coming weeks and months. And so thought you had an easy time just talking through the private client report. Sorry, it's going to be a little bit more in depth than that, but
interesting nonetheless.
Yeah. Let's kick it off. I do want to start with the PC. We're going to call it the PCR, Private Client Report. Wanted to start with that and just a couple of the big takeaways. So, one of the things that we always start with is we try to look back at the last year. So that would be 2025. What did we say going into the year? What materialized in a way that we thought it would? What happened, or what kind of surprised us? Anything that we learned from the last year? So kind of looking back at 2025, obviously we wrote that report right as the Trump administration was taking over. He was having his first days in the Oval Office, and so I think a couple things that we noted is that change of administration likely introduces some uncertainty in markets, right?
That's right.
And I think, the one thing that we typically point to is if there is a food item that the markets typically reject, it is uncertainty, right? That is a bad flavor for any type of investment. It increases the required risk premium, which tends to reduce asset prices. So uncertainty, never a flavor that markets are seeking. What did we see in the first couple months when Trump took office? Did we see some of that volatility? Did markets reject it? How did that play out?
Yeah, we definitely saw some volatility, especially, in and around a lot of the introduction of tariffs. That was, certainly a market moving event. And again, like you mentioned, kind of the trade impact of that, especially, looking ahead at that time, I think it really concerned a lot of investors. And so, obviously you fast forward to where we are today, some of the headlines and the news flow has shifted a bit, but, those tariffs have, for all intents and purposes,
differences, right?
Yeah, made some impact.
Yeah, I think if you're taking a measurement, right, the measuring, or I guess the concern in February was, well, maybe there'll be some tariffs and, maybe it'll make a difference, or we have some trade renegotiations. Mm-hmm. In April, it was full blown, the sky is falling and pricing in probably the worst case scenario, which was what markets were trying to do because they were surprised with new information, scrambling to try to get ahead of it and really just kind of de-risk to, okay, what do we know as kind of the worst possible outcome? How do we build something up from there? And then you had some, rapid rebounds. Obviously, you had the administration and Scott Bessent providing commentary to help, calm markets, which I think the markets did receive quite well. But, definitely, again, a reminder that uncertainty, if we have a fairly, high level of confidence that uncertainty is on the way in, right, is about to increase, typically we know markets, at least where that uncertainty hits, is going to, it's going to create a negative reaction. The bright side, the silver lining, is as we see this uncertainty materialize, to the extent that we can get comfortable with it being more temporal and less, less structural, we can take advantage of it, right? And so through 2025, one of the things that we are able to do for our clients in, a fairly systematic and consistent way was to harvest the volatility, and we do that through harvesting losses in our portfolios, especially where taxes are a big consideration. If you're able to harvest some losses, you provide almost like a tax rebate to the client. So that's always something that we can do that's, a little bit of a making lemonade out of the lemons of volatility. And then also rebalancing, right? What do we do when the market gets volatile and when it comes to rebalancing?
Yeah, really you take these volatile periods and, you can rebalance, your equities or your fixed income, depending on, which asset classes are performing, and it really kind of get back to a target, so that your risk tolerance, isn't out of, what you intend for your portfolio. And so we do that quite systematically. So we're actively monitoring not only the underlying portfolio positions, but also, asset class positioning and what that kind of does during the year.
The asset class position is a great thing to bring up too. And 2025, if nothing else, was a really strong reminder of why diversification still matters. We've gotten, I wouldn't say lulled into a false, set of comfort, but or a false comfortable environment. But the U.S. equity markets have been so strong for U.S. Investors and really investors around the world that, you can get a little bit complacent in your portfolio construction. You can think, well, the only thing I need to do is own U.S. equities and I'll be fine every year. In April, you didn't think that. At the end of the year, you were probably still fine. But we did see that having a globally diversified set of equities, even if you had 10 to 15% of your equity portfolio outside the U.S., it provided diversification last year, right?
Absolutely.
So that free lunch, tasted pretty good in December when you were looking at your returns and you saw, okay, well, the U.S. equities still did well, but that international portfolio returned, something closer to 30% for the year. So, just a nice reminder, diversification works. Concentration works until it doesn't, right? And then things tend to hit the fan. But, again, great reminder about diversification. And we're just talking about geographic diversification. And the news, right, tends to focus in on what's publicly available information. And, markets, at least public markets, tend to extrapolate things to, kind of maybe even sometimes worst case outcomes. A lot of other stuff going on last year that are in a lot of our client portfolios and that are things that, were positives, things to find attractive. One, again, pivoting away from public markets would be the private market side of the equation. The term great unlocking, I think, was used quite a few times during 2025. I don't know if I'd quite go that far, but the amount of or the level of M&A transaction really started to pick up last year. Gave us, some hopes that 2026, 2027 and beyond might be a pretty active IPO environment. Now, market volatility early on this year, maybe that means that those odds are a little bit lighter. But, the big IPOs that are trying to come out, they tend to be more AI focused. They tend to be more, space and defense focused with SpaceX, Anthropic on the IPO side, on the AI side, potentially OpenAI, right? All those names are names that I would say the recent market volatility probably, has a marginal, if any, impact on, and in some cases may even support it. So great unlocking, interesting dynamic to watch. What did we see when it came to just, big transactions happening in 25?
Yeah, well, you definitely alluded to it. You definitely started to see, a thawing out of the M&A market. And a lot of that, I think, was driven by, really kind of what we saw in terms of, a lowering of kind of interest rates.
Yep.
And, certainly I think you saw an impact, certainly in private equity, and venture sectors. You did start to see, some performance kind of start to show through. But again, I think like you mentioned,
so kind of just the start, right, is what it feels
that's
like.
Right.
It's got, and it's interesting too, because we've got, we also stay diversified in the private side of the world. And we use private markets in portfolios for specific purposes. And so what we've been doing a decent amount of over the past couple of years has been investing in private credit. And so kind of the yin and the yang of like private markets is, last couple of years, really good environment for private credit, tight loan standards, wide spreads, good return for the amount of risk that you got to put out. That has, changed a little bit over the last couple of years, and we'll get into that in a little bit more detail. But I think as it relates to the private equity side of the equation, the venture side, great unlocking. As the market has become a little bit less favorable to private credit, really one of the things that means is it is technically a little bit more favorable for private equity, right? Private equity companies or private companies tend to consume a lot of that private credit. Public companies do as well. But as the sun kind of dims a little bit on the private credit side, we look at that as sometimes an opportunity to pick and choose really good private equity investments because the borrowing cost is coming down, right? The ability to, transact or to buy other companies, right? That cost of that is coming down. And also, to think about from an IPO perspective, if your cost of capital comes down, your discount rate can also come down, and your ability to have a successful IPO, maybe those chances are increasing, right? And so, there's, again, we always like to say there's always opportunities in the market, even when things feel like they're going really poorly, there's always opportunities that are coming up. Maybe that's a good place to transition to one of our kind of non-PCR topics real quick, which is again, SaaS-pocalypse is an interesting word, which has been something that I think has touched the public markets and the private markets. Let's talk about the private side first, Andrei. So, our clients, many of them have invested in some private lending. We call them BDCs or business development companies. We tend to be more heavy users of privately traded, non-interval business development companies. So we don't do anything on the interval fund side, and we don't need to get into that today. There's some reasons fundamentally that we like the privately traded BDC structure for private lending a little bit better. But those structures and those funds have done quite well over the last couple of years, especially when you look at the amount of volatility that they've brought, right? Very low volatility and very attractive, almost equity-like returns. So all good things leading up to 2025 and even including 2025. But, as we kind of expected and as we had guided, throughout the year, the return experience on private credit is moderating a little bit. However, the news flow on private credit has really turned up the dial, right?
Yeah,
Last
right.
couple months of the year, how would you say the experience if you were if you were reading the news on private credit, how did that feel?
Well, definitely not good, because, you look at the headlines and, they definitely lean negative. We've heard about, certain sponsors that have had trouble, collecting on loans. They've had to mark some of those loans down. And so, naturally, I think an investor.
So, and just to kind of, bring that point out, there were some pretty sizable, loans that failed through either fraudulent activities, where the private company requesting the credit was misrepresenting whether it's their sales or their receivables, their inventories, they're pledging capital a couple different places for the same, or pledging the same capital in multiple places, right?
That's
Things
right.
that, are inherently, fraudulent activities, right? So we did see some of that in the private credit market, and it really just takes one big transaction to fail to get people scared.
Yeah,
right?
For sure. And, I think the other thing is, the way that news flow, I think, hit headlines, it made it sound very much, a systemic issue.
Yeah.
Where
like it's viral, it's going to spread across private markets.
Where in reality, it was maybe a little bit more limited to certain funds and certain parts of the market.
Yeah, and individual loans or maybe individual like subsectors or
Exactly.
very specific industries. Yeah. When we look at these private credit portfolios, I think one thing to to keep in mind is that like the word default or bankruptcy, that's a hot button word, right? And if you hear that and you know that it's associated with something that you have invested in, or even a brand of something that you may have invested in, it's kind of scary, and you don't want to hear that. Obviously, you never want to hear that kind of word. But if you look under the hood at these portfolios that we've selected for our clients, again, we view diversification as a core tenet of what we do. Most of these portfolios have hundreds of loans.
Yeah.
And so even if you hear that word bankruptcy and it's associated with a loan that you own, the likely impact of that on your wealth is very, very muted. And then when it becomes something that is connected with the fraud, well, that's typically, an isolated incident. If it's connected with something, which again, getting into SaaS-pocalypse, right, which is more an industry dynamic. And again, that is more, I would say, a little bit on the speculation side or a little bit on the kind of risk concern side right now, as opposed to actually being materialized. That could be something that I think is gathered a lot more attention because it's not idiosyncratic, or it's not associated with an individual loan. It's associated with an industry.
Correct.
Right?
Yeah.
And the private credit industry has really, been a place of first, capital for a lot of these software companies, which are harder to it's harder for a software company to bank with a traditional bank, right?
Yeah.
They're basically borrowing on cash flows.
That's right. That's right.
And so what does SaaS-pocalypse mean to you? Like when you hear that and you think about, the volatility that's created in the market, like what does that actually mean? What is SaaS-pocalypse?
Yeah. So, I think when you hear the word SaaS-pocalypse,
we gotta stop saying that word.
We really do. It's kind of hard to say, actually. Yeah. But in any event, when you kind of hear that, really what you're talking about is you're talking about the concerns about, software companies that have for quite a while now had pretty solid moats around their business. That has
think about the best software that you run at your business, right?
Exactly.
Like that's the companies that are facing volatility, right?
Right.
So why is there a concern around those companies that are just for the last couple of years have just been like bellwethers?
Yeah. Right? So they've had very strong margins. Obviously with those moats kind of in place, but now with the impact of artificial intelligence. There are some questions about whether that model now is at risk. So we've talked about the potential for, some of these AI models to be able to bring some of that software development in-house potentially for a lot of firms, being able to really customize solutions that, I think up until this point have largely been, provided by these software providers.
Yeah, I think companies are waking up to the art of the possible.
Yeah.
However, I think it's interesting to think about who is or what companies are best positioned to incorporate AI and the new capabilities, the new technology of AI into traditional business workflows, right? And I think the jury is still out, but there is a meaningful probability that the SaaS companies have the greatest expertise. They understand the data. They know where the data is. And they would be in a really good position to use some of these AI tools.
Yeah.
And I don't think the market is writing that possibility off. I think what the market is underwriting, at least in the publicly traded sectors, is the possibility that might not be the case, right? And,
yeah, that's right.
We don't need to assign probabilities to it. I think what the market is saying is that there is a non-zero probability now that these SaaS companies we may see a lot more DIY of software and a lot less packaged software coming out of SaaS companies.
And actually kind of tying it back to our discussion about private credit, a lot of those lenders obviously have lent money to these software companies.
Yeah.
And so it's really important to just keep in mind that, equity is very different from kind of the loan side of the book.
Let's separate the wheat from the chaff here. So equity, right? Publicly traded stocks that are SaaS companies, the public markets, they're going to price ahead, right?
That's right.
What do we think earnings are going to be like over the next 1, 3, 5, and most of the time 10 plus years? Discount all that back and try to put a number on it, right?
That's right.
And as an equity owner, you own the upside. So you take out all the liabilities, you own the cream that comes off of that after, you pay out your liabilities. As a lender, right, if you are invested in a private lending fund and that fund has made a loan to one of these SaaS companies, it's a different consideration, right?
That's right.
And so what are the differences in terms of what cash flows matter to that lender versus the cash flows that matter to the equity holder.
Yeah, I mean, you know, on the lending side, you really have to consider the fact that a lot of these loans are going to be shorter in duration. So you're talking, you know, oftentimes 2, 3, 4 years. And so I think going back to your comment about, you know, how it is that AI ultimately displaces some of these software companies, you know, that's probably going to be a little bit of a longer term game. So I think from that perspective, a lot of the private lenders that have made loans to these software companies are probably in a pretty good position because those cash flows are likely to still be coming in, you know, as that transition takes place. From an investor standpoint, you know, we've actually collected cash flows on a lot of those loans that have been made already, which helps to mitigate some of the downside. And then, you know, just that as a sponsor in the private credit market, you know, looking at opportunities, you know, if you do see the structural shift, naturally as a portfolio manager, you're going to start to probably look away from that at other places of the market that maybe are more insulated from, you know, the AI impacts over time.
Yeah, no, that's a very, very good point. So, you know, in terms of like what matters, right, to a lender, the cash flows that matter are only the cash flows that are going to come in during the term of your loan. And then, you know, hopefully you're going to get paid back your interest and paid back your principal. And if you sour on that industry, then that would be a place where you would pivot and go to the next, you know, the next industry or wherever your underwriting takes you as the best potential risk or reward per unit of risk. But there is some transition risk, obviously, and there are going to be, you know, if you are an investor in private credit, hopefully you've been invested in private credit for a number of years. You've had a great experience, and this is time to buckle up, right? I mean, there's going to be some volatility. You are not lending to companies that are investment grade. You're not buying, you know, treasuries, right? The companies you're lending against inherently could not get loans or could not get loans on favorable terms to bank or from banks or, you know, with just, you know, traditional lending. So they do need a little bit more or they do take on a little bit more risk. And that's why when we invest in that space, we try to invest in hundreds of loans at a time. So you're very diversified. There's very little individual company risk there. There is some industry risk. And the job of the lender, of the private credit lender, is to have sufficient protection in place. So they don't lend to the full value of the business. They tend to lend to a very, you know, a fraction of the value of the business. We call that the loan to value ratio. And they make sure that they are in a, you know, most of the time, hopefully in a senior position so that they are the first to get paid back if there is anything that happens that, you know, is a challenge for the business that they do have to kind of go through some type of event. You get a good recovery there, right? So that's kind of the job of the lender. It's also the job of a bank, right? A bank's supposed to do that, those sorts of things as well. There are some differences on the incentive side of things with private credit versus banks. There's obviously incentives for the private credit lender to have good performance of their portfolio. Might be a little bit different than a banking situation where you're actually selling a lot of the loans off of your balance sheet and trying to recycle that capital quickly. So some differences in incentives, I think, kind of, you know, put private lending in a place where the underwriting should be at least, you know, as good, if not better, than a banking situation. We are still watching that. We do expect some volatility, and in fact, we've actually seen some volatility in those private lending funds. There's been some, you know, reductions in NAV, and NAV is call it the book value, the reported value of the fund. So we've seen some reductions in NAV. That's, you know, kind of a prudent way of measuring the current value of portfolios, and that always assumes, you know, it always assumes some component of forward-looking, you know, whether it's write-downs or impairments. There's always, you know, something to work through in a private loan portfolio. So we're seeing that, and we're just trying to make sure that we navigate that with a cool head and a calm hand at the wheel. So last thing on the list today, and, you know, just made it on the list because it's super topical. And to caveat this before we get into it, you know, we're going to be talking about the war in Iran and its impact on markets, and just kind of remind, like, we're going to talk about the numbers, the financial side of things. Our hearts and thoughts and prayers go out to all the families that are, you know, anywhere near this, that have had their lives disrupted, that are having to deal with this on kind of the normal day-to-day, you know, experience, that it might be closer, you know, physically, or may have loved ones in the area. And so that's, you know, obviously something that we think about as well. But we're going to talk more about the numbers and what do we think this, event may do for global markets. So maybe just let's quickly recap. This started on Saturday, right? Andrei, what have you seen happen so far?
Yeah, so, going back to Saturday, we had Israel and the U.S. military launch a military operation in Iran, largely, driven by, what has been a terrorist regime that has really kind of unleashed terror not only on the citizens of Iran for the last 47 years, but really through its proxies across the Middle East and across the globe. And so really, I think what has happened is I think the U.S. and the Israel governments have, kind of seen this get to a point where the risk of potential,
like a tipping point, right?
Yeah, a tipping point with,
we're getting close to a point of no return, and we need to cut it off, right?
Yeah, that's right.
Yeah, so that's their thinking, and obviously the fighting or the attack started Saturday.
Yeah.
The market's reaction on Monday, I think, was much more of this is a midnight hammer. It's going to be a quick thing.
Yeah.
But the the bombing, or I guess the attacks and the retaliatory attacks have continued through the week.
Yeah.
The narrative from Trump administration, we don't get as much coming out of the as Bibi's Netanyahu's narratives, but so we don't hear a lot about that in the U.S. But whatever Trump is saying is much more to the tune of this is going to continue until we accomplish the objectives that they're set to accomplish, which is telling the market it's not a one-day thing. Obviously now it's a 5-day and going, continuing thing. It doesn't seem like this is going to end by the weekend, although it would be awesome if it turned out to be a 1-week event as opposed to a multi-week or multi-month drawn-out event. And so I think the market, Tuesday said, well, this could go on for a while, right? Yeah. And when you have that mindset, you start to look around the conflict and try to understand, okay, what things could go wrong, what could get if such and such asset or facility was destroyed, what would that do around the world, right? How would that change things? So let's start with that, right? Like, what is the market when you take a Google Maps view of the world? What are the things around that conflict that the world is really concerned about financially?
Yeah. So financially, anytime you talk Middle East, you have to talk oil. Oil is probably top of mind for all investors whenever they hear Middle East conflict, and for good reason. You take a look at the region, and you have the Strait of Hormuz, which actually runs between. It's a body of water that kind of runs between Iran to the north and then Oman to the south. And when you look at that body of water, you have a large percentage of the world's oil that actually transits through there as it comes out of the Middle East and gets, sent, really.
So it doesn't go through pipelines,
regions.
Right? It's going on boats.
That's right. Yeah. That is right. And so, anytime you have the risk of either a potential slowdown of those shipments, coming through the Strait of Hormuz, you are going to have some downstream impacts and effects in the market.
So where's all that oil going?
Well, so a lot of it actually is going to Asia, believe it or not. So, it's all kind of tied together, but, really kind of after the Venezuela, capture of Nicolas Maduro a couple of months back, really what ended up happening was that there was a shift of oil that was being purchased from Venezuela, then shifting to the Middle East, and from Iran specifically going to China. There are some numbers that I've seen that say that about 85% of Iran's oil actually goes to China.
Okay.
And so there are definitely some major impacts. And then you kind of look more broadly in that region. We had an announcement, I think it was yesterday or the day before, where Qatar actually talked about curtailing some of their liquefied natural gas. And so that also has an impact.
I saw there was, I don't know if it was an attack, but there was definitely some debris or maybe a small fire that occurred at their main LNG facility. And you were telling me that Qatar, I always call it gutter, I don't know what the right word is, but that they actually are the largest LNG exporter And LNG, liquefied natural gas, was kind of like a new thing a few years ago, but in terms of like how is that used around the world? So obviously to create heat and to create electricity, well, what uses a lot of electricity that we talk about all the time, right, is AI. And so the LNG side of things is an interesting dynamic, right? Because if you think about where is it going, right, a lot of it's going to the Asia countries, and it's a mixture, right?
Yeah.
So I think worth pointing out, China buys a lot of the oil from Iran, but China has multiple suppliers. So I don't know if 85% of China's oil is coming from Iran,
right?
Or if just if China is just buying most of Iran's supply.
That's right.
So I think the market movement on China hasn't been as severe as some of the other countries, because China probably has some other options to buy the oil.
Certainly.
They tend to they share a border with Russia, and they have pipelines, right? So they have a kind of a backup supply.
Yeah, that's right.
There are a lot of Asia countries that are surrounded with water. Japan being one, Indonesia, Philippines, right, where they don't have a pipeline option. They only have boats, and I think you've seen those equity markets. South Korea, another one, right? You've seen those equity markets sell off more significantly because it's kind of not their only supplier, but the next closest supplier is going to be U.S. South America region, or you find another way to ship that oil maybe out of through pipeline to Europe, out of Europe. I don't know if that's even an option, right? So that is significant disruption. But going back to LNG, so LNG is really interesting because there's no real pipeline option for LNG, right?
That's right.
You can't liquefy natural gas and then put in a pipeline. You can put in a pipeline, but it's
not going to go anywhere.
Yeah. And so the only way to put it on the ship is liquefied, right? Yeah. Which requires some really specialized equipment. So obviously Qatar's really good at that. They have the biggest facility in the world for that. But it's not like there's a next backup facility that can do about the same amount, and there's no rerouting, right? If you lose those liquefaction facilities where the gas comes into a pipe, so let's just say you had multiple pipelines of multiple natural gas pipelines, but they terminated other terminals, it wouldn't really help you. You need the liquefaction facility, and if that's shut down, then there's not really a backup.
That's right.
Okay,
that's right.
And so then again, going back to where's that natural gas going? It's probably going to power not just electricity generation, but a lot of data centers around the world.
Yeah, that's right.
Yeah, so really interesting stuff. So that's kind of the oil side, and that's basically what's coming out of the region. Right?
Yeah.
Closing the Strait of Hormuz. Yeah. Closing the Strait of Hormuz. Obviously significant disruption. Now, most countries around the world has some reserves. So a disruption for a couple of days, not going to be a big thing. We're going to see some price movements in the futures market, but in terms of the ability to actually generate electricity or run data centers, probably minimal impact. Going out a couple weeks, I think you start to get a little bit worried, and then you probably start to see rerouting of shipments around the world, right, to try to meet that need.
Definitely.
And when you have, it's not like you can just reroute boats and somebody else that was going to get that oil or nat gas doesn't need it, right? So then you start to see things get bid up.
Yeah, okay? And you are starting to see some of that impact in some of the tanker rates, as well as some of the, kind of insurance rates that, a lot of these shipments, are being charged. And so obviously that has some downstream effects to the buyers. And
so kind of interesting too, and we actually had some really intelligent guys from one of our energy investing partners in here. I'm not going to, brand pump them, but they've been talking about a really interesting dynamic in the oil markets, which is the U.S. shale markets and just the U.S. energy renaissance, right? And what does that do for oil prices around the world? And so what they've noted is that that the ability for the U.S. production to turn on and to turn off, somewhat rapidly, not overnight, but within call it a couple months, has kept oil range bound. And you could pick a range, but let's just say the range is $40 to $90, right? Yeah. That's not locked in, but as oil, kind of approaches, and I guess the spot price in oil is a little bit higher than 80 right now, maybe in the mid 80s. I didn't look at it this morning. But as oil kind of approaches that upper range, the capex of these, kind of shale producers increases, right? They get bigger capex budgets, the ability to pencil projects to profitability, much more increased. And so you start to see that supply get turned on fairly quickly, more quickly than if you were trying to do new deep water exploration.
Yeah,
right?
exactly.
So you have a little bit of a range-bound component on the oil side. Okay, now that has not, I don't think, been tested as much. It has not been tested as much as it may be tested over the next few months if this conflict continues to drag on, right?
Yeah.
But it has been tested with some pretty meaningful disruptions, and it's been battle tested, and it's proven out to kind of keep that oil price range bound. However, what we do notice is that in the shale markets, you don't really have, you can't most of the time independently produce oil and natural gas from the places that have a lot of oil reserves, right? Mm-hmm. You turn on the oil production, you by just kind of because they're coming from the same places, you automatically get more natural gas to a market that may not, have a need for that natural gas. And so what that creates is a little bit of an oversupply condition on the natural gas side.
Right.
So, and I don't know that markets are really pricing that part of it in. As we said before, getting natural gas from one country to another, right, getting it around the country, pretty easy, right? You just put a bunch of pipes around, and we have investments in those types of. We're constantly looking at those too, infrastructure expenses, right? But putting gas through a pipe is a fairly straightforward thing to do. Putting gas on a boat and shipping it around the world, much more complex. Much more complex. And so, if you've got this kind of non-market demanded increase in nat gas, but you don't have the facilities to export that as rapidly as it's been produced, what do you think happens in the U.S.?
Well, so I think, in the U.S., we're definitely in a fortunate position in that we do have, kind of oil independence and energy independence, if you will, in a way that we didn't really have it, decades ago. I think that has been a little bit of a shift. But that being said, I still think, if the closure of the Strait of Hormuz does stretch out, this conflict stretches out, beyond, a couple of weeks, then you are going to start to probably see a lift off in terms of, those energy prices, even domestically.
Yeah. So I think what you kind of get short term oil, again, definitely because it's easier to send around the world, right? You don't have to compress it to put it on a boat. Likely those are prices that are going to be a little bit more dynamic, mm-hmm. maybe some range-bound components with the ability to turn on more supply, but still definitely some pressure. Locally, you might see some softness in natural gas prices. I haven't looked, the last couple of days, but I would assume there's some softness already starting to creep into futures markets. Where that impacts consumers, though, oil, think about gasoline, nat gas, think about more electricity prices, and also maybe even the cost of your data center consumption. If you're mm-hmm. more of kind of an IT-focused, software-focused firm, might have some, might create some softness on those prices. But think about, gasoline versus electricity, maybe is a good way to think about it. And, I don't know if those would be mutually offsetting and then a kind of a neutral inflation component. But definitely some different dynamics in the short term. Long term, I think, if you lose supply, markets will find a way to bring underpriced commodities to that undersupplied area to normalize those prices over time. And so you would likely see, again, if there was damage to that gutter type of LNG export facility, you probably see an acceleration of LNG facility capex around the world to compensate, right?
Definitely.
So really interesting stuff. I know we're getting long in the tooth here. I do want to close it out though, Andrei. Any final thoughts? Bringing this, the PCR, the stuff we're saying in the private client report, back to the volatility that we're seeing in markets in real time.
Yeah. So really, I think just three things. It's definitely a very interesting and dynamic period in the market. A lot of drivers of volatility have obviously surfaced here over the last couple of weeks. So I think from an investment standpoint, number one, lean on your diversification. I think that's, something that all investors should really be kind of thinking about now. Second, anytime you see headlines and news flow, we talked about it with private credit, kind of take those things as headlines and, just consider that sometimes those headlines are somewhat divorced from kind of the underlying dynamics. And so
the drivers.
exactly.
Yeah.
And then I think third is, really, as we go forward, for the rest of the year, it's really just kind of having a good understanding of, your situation, your objectives, and, ensuring that your portfolio is really kind of lined up with those things in light of some of these drivers of volatility.
Great. Yeah. So having a good financial plan just helps you weather a lot of different storms, brings you peace in your financial life too. Andrei, this has been really interesting. I really appreciate you joining me today. If y'all have any questions for us, or you want to follow the conversation a little bit deeper, just come check us out on avidianwealth.com.